Thanks all of you for your attendance and participation today. This session this afternoon is a new one at Livewire Live, and we've put it together for you. It was actually Charlie that gave us the feedback at the end of last year's event and said, listen, all these investors have heard all these different ideas throughout the day, some of them conflicting. What would be nice is to have a little session where they can ask some questions and work out how to pull it all together and work out what it means for their portfolio. So that's what this session is about. And I'm going to try and answer as many of your questions as possible. So do pop those in. I'll jump onto the questions really quickly, but I've got a couple that I just thought we could just kick the session off with. Alex, I might start with you. Top 3 takeaways from the day. Were there any particular ideas that really resonated with you from the session today?
So look, thanks everyone first for staying around. And as you may or may not know, I'm not a financial advisor, so compliance has me say that everything I say is general advice by nature. Sorry about it. But no, in a hopefully a more interesting fashion, I think first key takeaway, the growth versus value debate is really truly alive, right? We are late cycle, which is probably also another key takeaway from this session today. A lot of investors talked about us being a bit long in this cycle or very long in this cycle. Therefore, what is good is expensive, and what is not so good is very cheap. And so it really depends on how you want to position or where you're going to try and find earnings. I think that's an important thing at this stage of the cycle. The second thing is that there's still very strong appetite for AI and private markets overall, and I think that's linked also to what we heard about the trends in digitalization, in deglobalization, in a number of secular trends that are going to drive the markets going forward. And lastly, I think it's important as well to talk once again that even if we are a bit late in this cycle and the risks of a recession have started to appear, the opportunity cost of being not invested is quite high as well. Remember, the S&P is up 18% for the year.
Okay, very good. Charlie, same question for you. Top takeaways from the sessions today?
Yeah, firstly, thanks for giving me credit for coming up with this session. So
it was actually in the complaints box.
Yeah. It was, I was going to say, because if it goes well, then I want all the credit. If it's crap, it was your fault for not executing. The three things I think. Firstly, the whole AI thing probably does 2 things. One, scares the shit out of me because I'm going to go to bed tonight thinking of Nick Griffin telling me how that robot changed the light bulb, and first it changes the light bulb and then it sort of takes over the world. But clearly out of the AI piece, bigger is better. What I heard today was, I think it was Ali's term, imposters. Obviously, when we're looking for investments in that space, it's really looking for those companies that have got the capital and got the ability to get it out and kind of get it done. The second one was one of the biggest questions that I get asked all the time as an advisor is, where are you investing now? How are you putting portfolios together? If I've got $100 or $1 million or $10 million, where do I put it? Honestly, let's just roll Todd Barlow from Soul Patts out and have him explain exactly what Soul Patts does. He went through a process of explaining that they put portfolios together by having a good base of good quality, large cap equities producing revenue. They have some powder dry to take advantage in private markets. They make sure they go and do lots of due diligence in terms of their private credit. They make sure they hold the best quality assets through the cycle, generate revenue, look for earnings growth. That's how you put portfolios together. Asset quality, diversity, hold some powder dry, and just hold really good quality assets and make sure that they're generating revenue. And then keep looking for opportunities in the market where you can add value to your investors. So that's only 2. I don't know what the third one is. The third one is that I don't think anybody agrees on whether we are, at this point in terms of kind of the bubble. I know that Bob Desmond sort of stood up and said things are, it's Armageddon and everything's going to turn to shit. And we had others stand up and say that this stuff will continue to run. My personal view around that is diversity is really important, asset allocation is really important, and making sure that you're holding good quality assets, that you understand what they're doing and they keep pushing cash into your bank account.
Yep. we've got some questions on private markets and portfolio allocation, which we'll jump into in a moment. But I want to find out if there was anything that made you pause for thought or particularly challenged any of your existing views. Alex, start with you.
Look, I think it was John Clark talking about company that have a moat versus thematic investing. I think that was really interesting because right now there's a lot of key thematics, as I mentioned, that have been driving the market because there's a very narrow set of stocks that are doing extremely well in what is, in the end, a slowing growth and inflation environment, right? The average company is being challenged because the consumer is under pressure. And I thought it was very interesting because, yes, thematic investing, there's a lot of hype around thematic investing, and we have to be careful around herding, but it's also what has been reflecting some structural changes that were underway. So yes, over the long run, companies with a moat, an established moat, able to maintain that moat, that sort of long-term structural competitive advantage, will do a lot better than the others. However, I think thematic investing makes sense, but it has to be a lot more tactical, probably on a 1 to 3 year basis, because these thematics, they change over time. So you can't stay too static.
Okay. Charlie, same question for you. Anything challenge your wisdom?
Yeah, Alex's accent's much nicer than mine, but literally what I wrote down was thematic investing. So I quite liked the picture that got put up of what I think it was Josh thought of
the poo slide.
Yep, poo slide. So we probably have the same view, and everyone already knows now my view, given that I'm sort of in the Todd Barlow and the Sol camp in terms of asset quality. You've got to look for companies that are able to generate their revenue through the cycle, have got good proof of concept, and got an ability to continue to drive returns for investors. So we're not big ones for thematics. We, like everybody else, understand the AI story, and we've certainly taken investment in various kind of mega cap companies, but we're doing it in mega caps because that's where we believe we're protecting client monies.
Okay, I can see there is a serious battle going on for the most voted on question at the moment, and Richard came down from the Central Coast. He was the first person I saw today. So Richard, you're going to get your question asked, and I think this is one I was going to get to anyway. How would you put together what does your asset allocation mix look like? What looks sensible over the next 12 months to 2 years, considering all we've heard today? And you can both have a crack at this one, and then we'll jump into the ETS versus managed funds versus stocks and where they might be useful within that portfolio. But Charlie, maybe start with what looks sensible in terms of the asset allocation pie.
Firstly, I take the view, and we're pretty lucky with the type of client that we've got, that every investor should be invested for 50 years, not for the next 12 months to 2 years. And I know that's a kind of cop-out kind of answer.
Unless they're thematic investing.
Yeah, unless they're thematic investing. Go and buy a goat or whatever it was on the thing. Look, every investment portfolio, and remember, whether you're 60 or you're 50, your time horizon's 40 or 50 years, right? So all of those normal kind of fundamentals that exist around good quality assets, et cetera. But to try and answer this question as directly as possible, certainly what we're doing, we've obviously been reasonably long equities over the last couple of years, and we've ridden that like everybody else has. We're looking to take some value. We, like everybody else, feel like some of the risks are tilted to the downside. We have had a reasonable exposure to private debt, which now we are moving away from and starting to take a little more exposure to private credit as opposed to private debt, because we believe those good quality companies that are taking on that debt to be able to grow. And again, Todd talked through the manner in which you kind of protect the downside and still generate.
So can you give me some percentage terms? Yeah. What is reasonable? What's an allocation?
And then the other one, is obviously private assets and private markets, where again, we, like everybody else, are taking a bigger and bigger allocation over time. I think once upon a time, portfolios were all made up of 60 to 70% equities, and it's just really because you could have just bought CBA and BHP shares and had good returns since 2009, because markets have basically done nothing but go up. So we're certainly down to sort of more like 30 or 35% in equities. We've got probably private debt, private credit exposures of sort of 10 to sort of 15%. we're holding a little bit of powder dry. We do expect that there's going to be a bit of dislocation. We do expect there's going to be some weakness and opportunity come along, and we want to make sure that we're there to be able to take that. And the rest we're looking for on a kind of case by case basis in absolute terms, looking for good opportunities in kind of private markets, which makes up the other kind of, I've lost count, but 25 to 30% of the portfolio.
Yeah. Alex, I might get you to hit the other question that's gone away. There was a question around ETFs, funds, and individual stocks. Where do you use those particular investment vehicles within a portfolio? Does direct equity exposure make more sense here in Australia? Do you prefer ETFs for certain types of exposure? And how do you make a choice between the vehicle you're going to use?
Look, I mean, it's a very good question and probably a never-ending debate. I think ETFs, they are very useful as a core position in markets where there's probably greater challenge to outperform, such as Australia. They're also very useful when you want to have a tactical play and you become more positive on a country such as what we were like on Japan 18 months ago. The other area where I see ETFs as being extremely useful is when you want to take a factor or style exposure, when you're want to go into value or into growth or into quality. They do give you exactly the exposure that you wanted, and there's no sort of drift from the manager. Now, I think it's also important for the long run to hire a manager in one's portfolio that will bring something different. They will bring some skills. They will be able to sort of look through the next 12 months and think on a more strategic basis. So we always have a blend. Where we probably have more passive investment and active is often in fixed income, where we want to retain the duration positioning and the split between credit and government bonds to make sure that we have the exact right exposure. And I think within equities, it's good to have a mix. And on direct stocks, I think direct stocks are fantastic if you want to have a long-term holding of a company where there's a structural long-term story that can add a lot of value to a portfolio as well, and they all can coexist within a portfolio.
Okay. Next question.
Can I say to that? The other really good use of ETFs, to be honest, is during deep periods of weakness. If you have deep periods of weakness and big sell-offs in markets, broad-based ETFs are just good, simple ways to get broad-based exposure. Where you take the view that everything has been sold off, then what's that old saying? All boats rise in a rising tide. Rising tide will float all boats, whatever it is. Whatever floats your boat. The reality is that you probably don't need to take the thematic risk or the stock-specific risk at those points in time, because if everything's been sold off, then everything's been sold off, which generally means when recovery occurs, most things will recover, which means that those ETFs are a good, safe way to do it. The direct stock argument, at the end of the day, as allocators of capital like we are and as advisors, there's no false economy. We need to generate good returns for clients. The only way you generate good returns for clients over time is a bit of concentration risk. So the purpose of direct stock portfolios is concentration risk and working hard to try and get the right portfolio together at the right time. So all of those pieces have their part. It's just, everybody should be going and getting the right advice of what to be buying at the right time to try and produce those good long-term returns.
Yep. The top question there, the biggest trends in wealth management. I'm not sure if that's as an industry or what you're hearing from your clients, but what from a wealth perspective, when it comes to managing portfolios, what are some of the big trends that you're seeing with your peers that might be useful for people in the room to understand?
Yeah, well, once was an investment banker, now is a private credit manager. There's more smart people in funds management than you've ever met before, to be honest. So there is a heap of product out there now. Like I reckon 20 odd years ago, choosing managers, choosing especially credit managers. Jesus, sorry. Anyone know that I'm a Liverpool fan? Sorry. I never know why my phone's off silent, but anyway, sorry about that. I completely lost my train of thought. No, there's just so many managers out there now, and there are new ones coming to the market all of the time. So the big one for me is make sure that you have a really good ability to do good due diligence on those managers, because you've never met a dumb one. So every single manager that ever gets put in front of you over time, especially these alternate managers, are super smart, and they will be unequivocal about their space, and they will be able to tell you why they are the smartest person. If you've ever had like renovations done on your house and you had the second tradesman come through the house, the second tradesman always tells you that the first tradesman was an absolute idiot and got it wrong, right? That's what fund managers are a bit like. They'll tell you why they're smarter than the other guys that have come along. So the only way to kind of guard against that is good due diligence, good screens, and a good ability to kind of get to the crux of why they're sort of making decisions. So yeah, the biggest trend is there is just so much optionality and so much product around at this point in time.
Yep. The discussion around private markets is something that, you know, it's present outside this room, but it was a big part of the conversation today. When is the too much private markets exposure? Because I think there's a lot of people getting excited about the opportunity. The case for private markets is compelling. We had some very charismatic presenters talk about it today. What do you think is too much of a good thing, and maybe provide some balance around some of the things that can go wrong with having too much private market allocation? Alex, I'll start with you.
What is too much? It's often too much when there's a deep sell-off in markets, and some of these funds that were sort of evergreen monthly liquidity then get gated, and you get a liquidity window, 6 months, 1 year later, etc. And you don't know the NAV that you're gonna get. I think for everyone, there's a trade-off between risk and return. Here we're talking about the liquidity risk. And very often it's very well rewarded. And I think for every investor, it's very important to know how much liquidity you're going to need by when. And that's, one piece of work that we ask all our clients to do before they invest the money is to know, have some foresight on their cash flow requirements. Because if you're putting money at work for the long run, then you need to make sure that you leave it enough time to go through the cycles. And I think, there is this trend that we've learned from the best in wealth management. All of us, we looked at what Yale was doing, and then the future fund got inspired from that, then the super funds, etc. And they all loaded up on private markets because there's more and more highly rewarding opportunities in private markets. And this sort of flows down to the wealth management, but everyone has to be quite aware that even though the NAV are more stable, then the liquidity might disappear very quickly, right? So that's, everybody's different. We like to own sort of, for an average balanced client, probably around sort of 5 to 10% illiquid assets, but we have a lot of charity endowment foundation that would have probably 30, 40% or even more.
Right. Charlie, so do you have anything to add on that front?
No, I mean, I think, we'd probably take the view that most people are underweight in terms of private assets. So, and that's really just a historical thing. Our average client is probably bigger than most, I guess, given that they're sort of 25 to 30 mil plus. Our view is that those portfolios should have kind of 25 to 35% in terms of private assets. We're not too worried about the liquidity, to be honest, because once you sort of start to build up a portfolio over time, you kind of have this staggered thing where money's kind of coming back, kind of over time, and you can sort of manage the liquidity risk in sort of that way. So,
yep. All righty, we've got just a couple of minutes left. Why don't we try and knock a few of these on the head as a bit of a quick fire? Any thoughts on crypto? Anyone want to take that? Has it got a spot in the portfolio?
Not really. Like, again, we're big ones for kind of quality, kind of understanding where returns are coming from. I guess, if you kind of go back and track what money means in terms of, it's valuable, it's scarce, it's separable. Bitcoin is probably all of those things, but, probably just too much risk and not enough regulation around it, if honest. So happy for people to kind of have small speculative amounts in it, but very hard for us to make it a core part of a portfolio at this point.
Alex, is it in the models?
Look, it's interesting. I think someone in Morgan Stanley wrote a paper 3 or 4 years ago about the benefits of Bitcoin or crypto in anyone's portfolio. In the case of, the answer to that in terms of benefit was mainly diversification, more so than capital growth. But 3 years later, the correlation of Bitcoin with the Nasdaq is extremely strong. It's actually 2 to 3 times play on the Nasdaq. So this sort of diversification benefit is kind of gone. Now, that's not to say that crypto isn't a thing, etc. And I think from the moment investors are happy to take on those risks, there will be plenty of use for cryptocurrencies in general, probably. But right now, this is not an asset class where we will sort of tell our clients to go in, and it's only on a reverse inquiry basis.
Okay, very good. We're going to do a little private credit, private debt slalom run. Charlie, can you please define the difference? And I'm glad someone asked that question. I was thinking the same thing. And then any managers you're particularly excited about?
I'll answer the second one first. Excited. Excited is a strong word. I'm not sure that.
Yeah, we're talking about private credit here.
I'm not sure that credit excites me that much. But in terms of managers, look, at the end of the day, with all managers, we just want people that have got good track record, a bunch of their own money in there, and good resources. So we like a few, right? We like GCI, we like Longreach. MA Financial have got some good products. Look, there are a raft of them though. Like it's actually hard to sit here and sort of name all of them. Manning Monthly Income Fund. There are a number of these funds. My advice to everybody though is making sure that the manager is true to label, has got good resources, and you've done your due diligence. And then we want to see that they've actually really aligned to what it is that they're kind of doing. So
yep. And quickly define the difference.
Yeah, the difference between in my mind, of the way I think about it, and I could be wrong, right? Private debt, we think very much about kind of property asset backed. So we think about all of the kind of private debt managers out there that are effectively just lending money out. So and there are lots of really good ones, and we absolutely have them in our portfolios. And the return over the last kind of 5 to 6 years, I guess, has probably the risk to the return's probably been a bit asymmetric. Returns have been really good and the risk has been reasonably low. The best managers are the ones where sponsor strength is really good and LVR is reasonably low, etc. But the way I think about private debt is when it's backed by property. So you just absolutely have to be mindful of what the asset is behind it, who the sponsor is, what the risk of impairment there is, what the construction risk is if it's construction debt, how long that how many loans are in that portfolio, how much turnover actually occurs, etc. Private credit, I think about where you're lending against. It may well be asset backed, but it's not often property asset backed. So lending to businesses, lending to quality companies that are trying to grow their earnings. So it's kind of corporate debt, corporate credit versus property debt.
Okay, thank you, folks. We're going to wrap it up there. There's a few questions still to go, but I'm conscious that it's been a long day. I really thank you all for your attention and your participation. Just a few closing comments. I'd like to say a special thanks to Bell Financial Group for their continued support as our principal sponsor. I'd just like to say a big thanks to the Livewire team that have been working hard behind the scenes to put this event together today. In particular, Maria Perez, who's been tireless. I thought all of our panelists and our speakers have been fabulous throughout the day. We do have a final survey where we're getting some feedback on the event. We want to continue to improve what we're doing over the years. So if you do have some time to submit your feedback on your experience today, that'd be most appreciated. And with that, I'd invite you all to come up and join us for the post-event reception, which is put on by Pinnacle. And also please put your hands together for Charlie and Alex for our final session.